So the market seems to be focused on your flat income guidance. You say it's because of rates. I want to know, and Anne-Marie wants to know, when the growth comes, will it come from China? When will the growth return to these numbers? Andy, good morning.
Good morning to you. So let me address that. What we are seeing, and we have seen over the last year, notwithstanding everything that's been going on in the COVID space, is good balance sheet growth. So we grew mid-single digits of balance sheet last year, and we think we will grow similar this year, and we can grow similar after 22. The reason why 2021 will be flat is because the interest rate reductions that occurred partway through last year will have a roll-through effect over the balance of this year. So the underlying growth is there. It's just the sort of correction of interest rates that will cause the top line to be flat. What we are seeing is the Northern Asia markets being the strongest, and that is well over half our business is based in that part of the world. So we are fortunate in terms of our positioning there. We're seeing Southern Asia a little bit softer, but I think tentatively moving forwards. And then the African and Middle Eastern markets probably a step behind those. So we are actually quite well spread across various parts of the world that are growing. The growth is there. The interest rate holds us back for a year, but after 21, then essentially interest rates normalised and we're back to the normal levels of growth that we saw before COVID.
Andy, in recent months, you resumed hundreds of job cuts. You continue to look for savings. What is going to be the cost savings narrative for 2021? Where are you going to be looking?
So, as with many businesses, we are having to look very, very closely at our efficiency. We're looking very, very closely at areas that have been changing, enhanced probably by COVID. So, a lot of digitalisation and a lot of investment that we've put in over the last several years to get the business more digital, to make us more sort of technology capable. We have said that for 2021, we expect our costs to be no more than $10 billion. That is a level that we have been at for 2 or 3 years now. In fact, in 2020, we're slightly below that. But this is constantly one of investing into new technologies to get the efficiency so that when the top line does pick up, we have got a great engine sitting underneath it to power us forwards.
Andy, you're going to take $500 million of a restructuring charge, primarily front-loaded this year. Now, the unfortunate truth is, to get these cost cuts through, it's going to mean more job cuts. I'm looking at your numbers. You've got 85,000 employees. What percentage of that 85,000 are you going to have to give bad news to and let go?
We have been focused upon the progressive reskilling of the business over the last several years, and that is a process that is going to continue going forward. So it is not as if there is a step change in what we're doing. We are constantly looking at things that we can do with technology that may not need so much human involvement. Equally, we're looking at areas where actually there does need to be more human involvement. So I think over a period of time, we will continue to see, as has been the case in the recent past, the headcount just gently coming down. What I think is a little different, actually, and it's part of the restructuring charges that we're talking about, is the use of property, the use of office space, where the lessons of the last 12 months, we have on the average had 75% of our people worldwide working from home. And that is actually the case as of today. That is a very high percentage. It's something which a year ago we would not have envisaged. So as with a lot of businesses, I'm sure, we are looking, once people come back to work, at just how much flexible working could we actually continue with? Does that mean the office space we need and the requirements for it will reduce? And hence, do our lease requirements and things like that over a period of time, do they start to come off?
Andy, a lot of banks are looking at that. Just this week, HSBC cutting their global footprint by 40%. How much are you going to trim in real estate around the world?
We're working through that, but it wouldn't surprise me if we are somewhere a third or thereabouts over the next 4 years or so. It won't happen overnight, and obviously we've got lease commitments which we need to honour, but I think we'll be looking at something of that sort of order over the next 3 to 4 years.
So does that mean that you will pivot to the Bill Winters, the hub and spoke model? Is that going to be how you get to reduce 30% of your office footprint. Is that the way forward?
Well, I'm not quite sure what the Bill Winters hub and spoke model is, but I mean, certainly what we're saying is people can
having
work
offices. Forgive me. It was a story that we wrote. My apologies. I shouldn't presume that you read everything on your Bloomberg terminal. Sorry, Andy. Basically, is that you trim the offices, and if I'm at Standard Chartered, I get to work at a small hub satellite office near me. Is that part of the thinking?
It is. So we are saying people may want to work more at home. We have entered into agreement with IWG, who have got office space in many, many locations in cities in which we operate, where people can use those as drop-in facilities. We're looking at our retail branches and seeing whether actually some of those could be used as sort of drop-in facilities as well. So generally giving people more flexibility as to where they go, and once they're there, they're plugged into the overall system. It doesn't actually make a huge difference. And of course, because we are so spread across countries, a lot of our activity is actually done by video conference, etc. anyway.
Now that you are restarting the dividend, you join all the other major British banks. We have a full sweep. What is the size and scale, though, we can see the increase in the dividend?
So, as with all banks in the UK last year, we had to halt dividends, and we were also in the middle of doing a share buyback programme, which was actually unusual amongst UK banks. What we said today is that we're going to complete the share buyback programme, so about $500 million to complete that. And we're going to pay a dividend of, again, about $250 million on top of that. So as of today, it's $500 million that is coming back to shareholders. But what we have said is that as the COVID situation normalises, we are very, very focused upon getting the return on our capital up. And that means that any excess capital we have got that we can't use usefully, profitably within the business, that will be destined to come back to shareholders over a period of time as well. So hopefully we're now back into a more normal situation where returns to shareholders can recommence, and we'll do a mixture of buybacks and dividends, and particularly whilst the share price is relatively low, the buyback's obviously pretty attractive.
Strategy going forward, restructuring a bank is never easy. Does private banking still fit in the Standard Chartered model? I know that you've let some people go here, but I look at others scaling up their business. You are a trade bank. Does private banking and wealth management still really fit in your business model, or would you seek to perhaps divest yourself of that business?
No, we would not look to divest that part of the business. We do see it as being integral. We are a trade bank, that is true, and the biggest part of our activity is servicing corporates. But at least a third of our business is servicing individuals, high-end individuals, and we see the combination of supporting people, some of whom then run the businesses that we support as corporates. We see it as being quite integral. The private bank area is quite a niche area. It's a growth area, particularly a lot of money going into Asia. We've got a good reputation there. We are relatively still quite small, but we see that as being actually opportunity. So, no, definitely part of the suite as we move forwards.
Andy, I want to get your sense about the geopolitical risk in Hong Kong. It's one of your biggest players. Are you seeing clients starting to withdraw from the city?
No, we're not actually. Obviously, there's been a lot of news about the whole situation there. But generally on the ground, I think people are much more in a sort of watching mode, and being a little bit philosophical, I think, about what is happening at the moment. So activity levels there have remained strong. Our results are a little bit lower, but that's almost all because of the interest rates, not because of the volume of activity. And what we have seen is good growth in our business in China. So we are fortunate. We've had 160 years of presence in both Hong Kong and China, and particularly the Greater Bay Area, which we have invested in, and we've opened our regional office there recently. We've put more staff into it. We are actually seeing that the overall activity levels in that part of the world are holding up, notwithstanding some of the things that have been going on at a sort of higher geopolitical level.
It's never a financial interview without a little bit of Bitcoin, Andy, so you're not going to escape. Where are you and the team on Bitcoin when you look at it? How will you participate in Bitcoin and cryptocurrencies, if at all, this year?
So we have been investing selectively in some blockchain technologies and some crypto businesses. We are clear that the technology has a really interesting future. But as we all know, there are sort of issues that go with it in terms of sort of trustworthiness and the sort of things that actually, when you're dealing with money, are really, really important to people. So we're essentially sort of hedging bets, as it were. We are playing in that space. We will see where it goes to. And if it does take off in a bigger way, we're well positioned to do that. But I think this is one which is on a sort of slow burn for reasons which are pretty apparent.